I'm Real Stan Roberts. It's the Real Investment Show on this pre-Friday Eve edition. Of course, Michael Leibowitz joining us this morning live from Washington, D.C. Hey, Mike, how are you this morning?
I'm doing well, Lance. Thank you.
Good. Interesting comments out yesterday from the FOMC, talking a little bit about the fact that they actually, for the first time, mentioned with any type of, specificity about the overvaluation of the markets. In fact, they were particularly concerned with what's kind of happening in the leveraged loan market as well as some of the other credit markets. But a little bit worried about the kind of the exuberance of the market itself. Really kind of the first time you've seen them express real direct concern about valuations in credit markets.
Well, I think what's interesting is first understand that the Fed had their meeting, I believe it was January 28th or 29th, it was about 3 weeks ago. And they didn't say anything in their minutes, but at the press conference, Chairman Powell said that asset levels, and I don't believe he named any asset market in particular, but he said are somewhat elevated. 3 weeks later, they put out the minutes to that meeting. Mm-hmm. And we all know that they modify those minutes. So it's not true minutes. It's minutes plus whatever changes they want to make based on market reactions and what has happened in the world over the last 3 weeks. And they upgraded the stance from somewhat elevated to, I forgot the wording, but elevated.
Right.
Basically telling you that they're, I don't know if not happy is the word, but they've certainly noticed that assets have gone straight up. And despite a virus that does not only not have a cure, but it's starting to spread outside of China.
Right.
And it is hampering growth, not only in China, but now we're getting signs from all kinds of global companies that they have problems, including Apple. The darling of the market.
Well, yeah, exactly. And, that's kind of an interesting thing because even these minutes, though, were before the coronavirus actually hit. And the Fed has announced that they are watching this and they are concerned about the impact of the coronavirus to kind of the global economy. But one thing I thought was interesting in their minutes is that they did mention that, current stance of monetary policy and the things that they're doing may be less effective or ineffective in the event of the next downturn whenever that occurs. And that kind of makes sense to some degree. I mean, you've been running a tremendous amount of kind of monetary and kind of this idea of policy over the course of the last, decade. Interest rates are at 1.5%, very close to zero on the 10-year Treasury. The Fed funds rate is at 1.5%, very close to zero on their policy. There's not a whole lot of room to cut rates, push rates, and because the whole point of monetary policy is to try to lower the borrowing cost of individuals to help spur the economy. But you don't have a whole lot of room to get rates down to zero. I mean, there's just not a lot of firepower there to work with, and your balance sheet's already $4 trillion. So, you've got to grossly expand that balance sheet to have the same impact to creating market valuation increases that you had back in 2009, 10, 11, and 12, right?
Right. And the amount of debt matters. So even if rates go to zero for corporate bonds, so many companies are sitting at BBB and don't want to be downgraded into the junk category that they won't take on more debt. So many consumers are just stuck with so much house debt, with so much car debt, that even if rates are zero or even negative, can't take on more debt. So it's not just lower rates, but it's the problem that if they lower rates, who's going to come? Who's going to borrow money?
Right.
And surely the U.S. Treasury will. They benefit. But it's not clear to me that the marginal benefit is shrinking quickly as we go lower and lower. And this is so evident in Europe and in Japan, where rates are negative. And rates are even negative for corporations in some cases in Europe. And even a couple junk-rated corporations have gone below a zero interest rate. And look at their growth. It's negligible.
Well, it's interesting that when you talk about junk-rated companies, this is your cousin Vinny that has never had a job and he comes to borrow money from you. It's almost a surefire bet you're not getting paid back, and yet there are investors willing to pay that company to take money from them. And that just really kind of, when you talk about the exuberance of the market and where we are now after a decade of this kind of advance in the markets, when we talk about investing and risk of investing money, people have really forgotten what risk actually means.
There's no risk premium to anything anymore. I think what you just said is a perfect example, right? Why would you lend someone money at zero if there's a risk that you're not even going to get zero back? It's bad enough that you're not going to make any money by lending the money and there's an opportunity cost. Mm-hmm. But the fact that there's only called a 97% chance or 92% chance or 80% chance that you're going to get the money back is stupid. They're not stupid people. They're just being forced into making stupid decisions by the central banks.
Right. So let's shift this around here a little bit. You wrote an article that's out on our website yesterday. And if you go by the website, realinvestmentadvice.com, we've talked a lot lately about, about the Federal Reserve and about these things. But, there's other factors that are going to the market. And you wrote an article about this yesterday. Let's talk about that.
So we wrote one article for Pro about a certain company that is not value anymore. And we wrote an article dissecting the fixed income market and in particular corporate bonds and where you might find value.
So we're talking about now the Federal Reserve has created this, this problem where value really isn't opportunistic. You can't find value currently, and people are discounting value because they would rather be in kind of the growth, taking on the risk and the growth of the markets. And so this idea of the suppression of value has become a much bigger issue.
So I think both you and I, Lance, are trained to find value. As every investor should be, right? Mm-hmm. You want to buy something at 70 cents on the dollar that you think is worth $1, right? I mean, that's what we're trained to do. That's what we should be spending all our time doing. We shouldn't be talking about the Fed, but, that's the way it is. And we acknowledge it and we manage our portfolios accordingly, but we're always on the search for value. And one place, when we look at fixed income, one place where there is no more value is the corporate sector. Corporate bonds have just gotten extremely rich versus any kind of historical level. And when we mean historically rich, we mean how much more yield do you get versus a comparable maturity U.S. Treasury. Mm-hmm. And the spread or the difference between those two is just ridiculous at this point. It's so tight. and it's not just corporates to Treasuries, but within the corporate sector. So a AA versus a triple B or a triple B versus single B. The difference in the risk premium is just so tight. So we took a look through the whole fixed income sector, and we discovered that mortgages are somewhat cheaper, that there is value. And while they're still on the rich side, there's a lot of value in owning mortgages versus corporates. And in the article, we talk about looking at yield and looking at risk as measured by duration. And I think the article it not only exposes that the mortgage sector is somewhat cheap, that the corporate sector is rich, but it just shows you one different way to evaluate bonds and how to separate bonds, at least between the different asset classes and try to find value.
Yeah, but I think the overriding point about this that people should take away from this conversation is that investors are seeking yield, right? And because the Federal Reserve has been suppressing interest rates near zero for almost a decade, we've got very low rates of return and money market funds, et cetera. Investors have been forced to try to chase yield somewhere, right? So the question is, I've got cash, where can I make some money on it, right? I can't make any money in my money market, so I've got to go chase something. And what investors don't realize is that when you start stepping out that curve to get a rate of return higher than what the 10-year Treasury is providing you, which is the de facto risk-free rate, they don't really realize how much risk they're taking about potentially losing a large chunk of their money. But this is the risk of chasing yield. It's like buying dividend stocks and holding them, expecting the dividend to always be there for you, regardless of what happens to the price. That's all fine and dandy until the company cuts their dividend, just like happened with Six Flags today. Stock's going to be down 20%. If you own Six Flags for the dividend, the stock's going to be down 20% today, and your dividend's been cut. So what was the point of holding that stock again? Be right back after the break. Big news this morning. Morgan Stanley is buying E-Trade, which is not surprising following the fact that Charles Schwab recently bought TD Ameritrade. So just the consolidation of brokerage firms and online brokers, everybody trying to get into the I can trade everything for free game is really kind of accelerating. Remember, free trading is not really free for you. This is all about order flow. So if I can get more and more trading done, bundle shares, trade them off on order flow, sell them to hedge funds, sell them to other major institutions that are passing these shares back and forth, they can make a lot of money from that. So paying for order flow is kind of a big thing. So free is not free, and especially for retail investors, you actually tend to not get as good of execution as you would otherwise. And this has just been an evolution of the markets now for the last really few decades, which began with when we went from fractional share trade. We used to trade shares in fractions, a quarter, an eighth. So it'd be, $10 and a quarter, 10 and an eighth, 10 and a half for a particular stock. Then we went to pennies. And that was the beginning of that evolution towards shrinking costs and pushing institutionals into other ways to manufacture profits out of trading, and this is kind of the latest innovation of that. So order flow is kind of where everything is headed, and this whole consolidation is, I'm not sure, works out to the best advantage of the individual investor. But I guess we'll wait and see about that, Mike.
It allows them to hide their costs. It's kind of like the airline industry, right? Mm-hmm. They may have brought down airfare slightly, but then they nickel and dime you with all your luggage and seating and everything else. And at the end of the day, it's more expensive, even though your seat may seem a little cheaper.
And a little smaller and a little narrower. And
Exactly.
Yeah. And now it used to be when you sat in the emergency row, they go, now, sir, are you able to perform the exercises needed to sit in the emergency row? Now it's just, do you want to sit in the emergency row? That's $15 extra for the extra 2 inches of foot, leg room that you get there.
Right.
We don't care if you can actually open the emergency door, but we just want your $15, right? Or whatever it is.
Right.
All right. So anyway, one of the interesting things, kind of back to the Fed for a second, we were talking about the release of the FOMC minutes yesterday and kind of their rising concerns over, kind of valuations in the markets. They also discussed the fact that they will be winding down repo starting going into April, and really kind of post-April. They'll start kind of winding that down. And removing that benefit. It was interesting because Neel Kashkari has been very vocal that, these actions don't really supply liquidity to the market. And he doesn't really understand why people think that, this has anything to do with the financial markets whatsoever, other than the fact there's almost a near perfect correlation between the Fed's actions and rallies in the market. So, outside of that small coincidence, Neel Kashkari thinks there's absolutely no linkage whatsoever.
And he likes calling people like us that point out that there is a correlation, and there should be a correlation because the actions actually do affect it. Conspiracists or gold bugs, and
exactly,
he's a class act.
Yeah. So but he had a comment out yesterday too, right?
Yeah. He said something to the effect that low Treasury yields are an expression of confidence by investors. So as yields go lower, that means investors are getting more and more confident. Well, it does mean the price of bonds are going up, so yields are getting lower. So I could see how a 10 or 15-year-old might confuse low interest rates with confidence. But if you look across the pond over at Europe or Japan, where interest rates are negative, there is very low investor confidence. Right. The reason rates are low is because growth prospects are low. Mm-hmm. That's why rates are low. The Fed is buying securities too, which is also making it low, but that's not because of investor confidence. That's because the Fed's manipulating a market. And look, the bottom line is he's wrong. And even Janet Yellen has said as much. She a couple of years ago was worrying about low rates because they basically signal that there's bigger problems with the economy.
Right. Well,
she has said that, and Bernanke has said that on numerous occasions, that low rates are not signaling good things.
Well, the thing here is that, really it doesn't take a lot of work to go look at, economic growth, inflation, and interest rates. Back in the early 80s when Reagan was in office, we talk a lot about, how Reagan was in office. We created this great economic boom, blah, blah, blah. At that time, at that point in history, interest rates were 12, 13%, and economic growth was running at, 8, 9%. All through the 90s, as interest rates fell and inflation fell, so did economic growth. By the 90s, we were growing at 5%. Interest rates were running around 5%. Inflation was around 5%. In early 2000, we were running in the 4s. That's where inflation and interest rates were. Today, interest rates are at 1.5% to 2%, somewhere in that range, and economic growth is where? Around 2%. So, it's not really a sign. Lower interest rates are not really a sign of economic growth. To your point it's really more representative of low rates of economic growth. That's the reason interest rates are low. And that's because people can't afford higher rates. And we saw this in January of 2018 when Jeff Gundlach and Bill Gross and others were talking about how interest rates were going to go to 4 and 5%. And we were writing articles. No, it's not, because as soon as you get interest rates up more, have a change in rates by very much, you're going to immediately impact the housing market, the auto market, the credit markets, et cetera. And we got to 3.2%, and the wheels came off the cart. So,
right. If they're right that rates can go that high, there will be a depression that makes the 1930s look like a piece of cake.
Right. And
there will be defaults of a massive level. So we have no choice but to have lower rates. The
correct.
Fed, right? If the Fed does not want to administer a depression or a very deep recession, they have to force rates lower. And they are doing that. They're doing it with QE. They're doing it with repo. They're doing it with just the words they use, right? They're doing it through messaging. And that's not investor confidence. That's forced lower rate policy.
Which is what you need to supplement economic growth. And this, you brought up a minute ago about talking about autos and about the fact that consumers are unable to just continue to, steadily take on more and more debt. And I think the auto market's just a great example of this because we lowered interest rates towards zero. We got people into cars that basically are 0% down. And we began stretching those payments out for 6 years, 7 years, 8 years. And we talked about this a couple of years ago. We said one of the interesting things is that when people try to go trade these cars in, they're going to be rolling negative equity into their next car. Right. And eventually they won't be able to roll the car because they'll have so much negative equity that they won't be able to finance the next car. And we're actually starting to see that happen. We're starting to see defaults pick up on auto loans, but also we're starting to see the impact of all this rolled in negative equity. People are unable to finance the next car because they have too much negative equity and they can't afford the payment. So if interest rates go up at all at this point, you have an immediate slowdown in the auto sector. And look at the mortgage index yesterday. Mortgage application index dropped 6% yesterday because we had a very small uptick in some of the lowest mortgage rates we've had in history. Just a very small change. All of a sudden, people said, nope, not doing a mortgage.
Right. We actually, in RA Pro, I believe it was yesterday, may have been the day before, we showed a chart of 90-day delinquencies in autos. And they are almost back to the level of 2008. They've been on a steady climb higher over the last 4 or 5 years. And I think, Lance, it's exactly what you said. Look, we have record low unemployment, at least officially. And we have the greatest economy ever. But why are so many people that delinquent on their auto loans, and at a level that's 2008 like?
Right.
Like that was a recession. Those were some bad times.
Right.
These are the greatest times ever, and we're having delinquencies on par with a recession.
Which, yeah, and again, this is also part of the story of this disparity of wealth in the country as well. You know, we do have a very strong economy, and people are doing very well in it if you're in the top 20% of the economy. Those are the people that have money invested in markets. They're participating. They feel great. In fact, when they do, you know, Gallup poll surveys, et cetera, it divides along two lines. It divides along your political leanings. So Republicans are much more confident about the economy than Democrats are. But it also leans along your income levels. And so those in higher income levels they feel very strongly that the economy is doing great. It's fantastic. If you're in the bottom 80%, not so much. But that just really kind of goes to the point that this has been a deviated growth in the markets between the shrinkage of the middle class and this expansion of the upper class.
Right. And the other thing is we've been in an expansion for 10 years now. So those that are very confident, how many more vacation homes are they going to buy? How many more cars are they going to buy? Mm-hmm. The marginal desire to buy some of these goods is very low now because they've bought them.
Right. Yeah. How many more yachts are you going to buy, right? Depends on if you're on E-Trade or not. So
right.
So all right, well, we got to wrap this up, but so Mike, you know, the thing, we do have an article out on RIAPro.net right now, which is actually talking about dividend yielding companies. And I kind of mentioned this a moment ago about with Six Flags. You know, one of the big fallacies of investing is that individuals say, hey, I just want to buy it for the dividend. I'm just going to hold it for the income. And it all works out great until you lose 30 or 40% of your money, right, and the dividend gets cut. We have an article out on RIAPro.net. You can try it for risk-free for 30 days, but read the article because we're talking about a specific company that kind of fits in this bill, and it's a well-known company, and it's one that you probably own somewhere in your portfolio, either in your ETF, your mutual fund, or directly. But we've got a whole series of these articles coming out that Mike is writing, and they're all on our website at RIAPro.net. Subscribe risk-free for 30 days. Check it out. Read the article. And we'll be back tomorrow for the next edition of The Real Investment Show right here. RealInvestmentAdvice.com. Get our latest articles, podcasts, and more. RealInvestmentAdvice.com. Have a great day. We'll see you tomorrow.
It's a rich man's world. It's a rich man's world.